Hello everyone, my name is Kamal Manocha. I represent PMS AIF World. Over the last 4.5 years, our journey has been, full of a lot of knowledge sharing, a lot of alpha creation for our clients, and we are like very passionate about understanding, what are the products which are still sincerely focusing on generating alpha. The markets have, reached a certain level from where I think boys will be differentiated from men, and hence it is important to understand that how portfolio is structured in terms of beta, how portfolio is structured in terms of information ratio, and hence we do a lot of objective evaluation before we sincerely suggest a product or make a opinion about the product for our clients. And over last 4.5 years, today we have more than 1,000 crores of assets. We are serving clients across more than 20 cities, more than 5 countries, and we welcome our clients, we welcome investors who really want to build wealth, who really want to participate in the real story of wealth creation through very well informed investing in a very articulate way by booking appointments with us, not taking much time, and starting this webinar, taking the process ahead. Today we have Sonam Srivastava, who is one of very sincere fund managers. I recently had a chance to meet in person during my last trip to Mumbai. And I can say very confidently, Sonam has started recently over the last 1 year and has crossed 100 crores of assets. But, like every fund manager aspires. But here, besides just aspiration, there is a lot of zeal and a lot of, I would say, sincerity to not just grow assets, but also ensure that alpha, is there for clients, because clients and investors are more keen for outperformance over the benchmark. Sonam, is a very well-known otherwise face because she has been running very successfully, a small case strategy and was catering to thousands of investors. But now in this journey as a PMS, we at PMS AIF World are proud to do presentation with you, Sonam. We would like to understand, what has been your journey, as you progressed from small case to PMS. What were the risks involved? And now, obviously, from 100 crores onwards, now you'll be scaling, and we are also seriously looking at allocating some money to you through our clients. So it's a sincere endeavor to understand your product from that point of view as well. So it's not just a webinar that we are doing for audience, but I'm also part of audience, and I'm also wanting to understand that. And I have certain set of questions that I will be asking you post your first presentation is done. So I understand that your strategy is quant focused, and that goes in line with your background. Before I say much about it, I want you to kind of spend your first 30-40 minutes to discuss what is your macro view as a fund manager, what quant is saying, because markets are like at the moment in a trajectory where maybe a quant can give a better perspective. So it's equally important to understand. So if you can maybe start by giving a macro view and then maybe a sectoral view, and then it will be interesting to understand, how are you deploying money in your 3 PMSs that you have, and then after that we'll do Q&A.
No, definitely. And thanks a lot, Kamal, for the introduction. Right. And it was amazing meeting you also. And we get many people tell us that, they've seen us talking to you on the webinars, and they've learned a lot about us through this. So, very glad to be here. I'm just trying to upload my presentation, Kamal.
Sorry, I was on mute. I didn't realize. You can share your screen on the top. You can see the fourth.
Acha, I can share my screen?
Yeah.
Okay, wonderful. Then okay. So I have a presentation for you guys, and we've also, I think, evolved a lot since we did our last webinar on PMS AIF World, right? First thing, Kamal, you'll notice is that the branding has changed, right? Wright Research, a lot of people know we're calling the PMS side of things, or the more affluent segment, the Wright Gold product, where we have branded it with this premium black and gold design. And like you asked me, Kamal, it's been a very interesting journey with this PMS. We've learned quite a lot. See, doing advisory is simple, right? Much more simpler in comparison to the PMS. There's so many things you need to do or trade execution. But along with it, you can be much more active, because you can take calls much more proactively with this structure, right? So there's a scope to do much more. Us being very small in terms of our size, we also have this opportunity to go with a wider set of stocks and do much more. So it's been a very interesting journey, and we have evolved quite a lot through this experience. I'll start off by talking about our understanding on the market, right? I think in the current scenario, whichever client I talk to, they have a concern about what's happening around us, right? Obviously, the biggest thing that people have in their mind is the election, and I don't have much to comment about the election, but in terms of data, right? So Wright Research looks at data. In terms of data, if you look at it, you see that election results tend to have a positive bias, right? Elections before and after, the markets tend to have a positive bias. Obviously, it doesn't happen all the time, but that's the broader trend. Obviously, there could be a trend change if a surprise happens, or there could also be a trend change if a surprise does not happen, right? So election results are actually, one thing that we've learned is unpredictable, and not just in terms of results, but also in terms of the market movement. So while we have a very positive bias towards the market right now, we do expect a little bit of volatility, right, around those the 3-4 days of the election results, and we are planning to counter that volatility by strategic deallocation. Our allocations are shifted towards large and mid caps right now, and we might also hedge our portfolios around that time. So we are very well prepared for this scenario. But yeah, what we are extremely positive about is the macro picture in India, right? India continues to remain the brightest spot in the world. Everybody in the world wants to invest into India or is looking at the India opportunity. And the growth rates, which were already a standout in the global economy, has been re-rated, right, to more positive figures by various people across the world. And that gives us the confidence that the equity markets will be supportive. There are a little bit of concern with these geopolitical scenario in elections, but there are bigger positives also that are out there. Rate cuts could happen, right? And the resurgence of various sectors would occur when that happens. So we are actually quite positive about the next few years. But yes, like I said, we are being cautious because of certain big events happening, and therefore you will see our allocation right now is mostly large and mid caps, with a few small caps also out there, right? Another important thing that we'll talk about is expectations, right? I think earnings this time have been a mixed bag. There hasn't been anything extremely negative for sure. There have been positive surprises and negative surprises. I think the TCS, Infosys, all these IT stocks, while nothing to stand out in their numbers, they did showcase that they have a very strong deal flow, which will be positive for the next few sectors. Certain banking stocks like Axis and ICICI came up with very strong numbers. The FMCG pack still sort of disappointed, and that was expectations were not beaten. Like, as in the earnings were as at par with expectations. Some of them underperformed, but all in all, nothing too disappointing about the results. We saw Vedanta come up with their results, metal segment, while the earnings were not that good, but the stock rallied, right? So I think people are betting on their expectations, and the earnings, have been relatively strong in that sense. Now, the bigger thing to understand here is, and what would define the direction of the market more than anything else, is the rate cut expectation, right? So from how the commodity prices are moving to how the markets are moving, everything depends on the rate scenario. And here we saw a very interesting data point come out from the US Fed last month, where they said that, okay, the growth in the US has slowed down, right? But the inflation hasn't slowed down. So that is a concerning point for the global economy. And because of that, people expect, rate cuts to be push down further. So right now expectation is in September it could move because there's just a few percentage point of difference between the expectations. So we have to be cautious of that. I think this will be the biggest event to watch out for. And if the rate cuts happen, they will bring out a resurgence of real estate, banking, automobiles, infrastructure, and everything else, right? But the rate at which these cuts happen, right? If they are delayed to a lot, that would be a concern for the markets. Having said that, I think another important thing that people are talking about right now is the commodity prices, the metal prices. Metals seem to have been the standout sector for the last few months, right? Ferrous metals, non-ferrous metals are rallying like anything this month because of the strong demand coming from China and certain supply side issues that have happened over in Russia and a few other geographies. I think the metal rally, it seems to be strong right now, and I think it would continue for a few months. But I think around June we would know if the demand in China is going to sustain or not. It might be that this is a seasonal pattern and the demand does not sustain. But right now, this sector is definitely looking interesting. So that is a brief overview of the macro scenario. There are big events coming: Indian elections, US elections, and elections all over the world, the geopolitical concerns. But the outlook for India definitely remains positive because of the strong growth, because of the demographic and the development that is happening in the Indian market. Along with it, we talked about rate cuts, which will be the big event to watch out for. And now let's try to jump into some numbers and understand our sectoral view. So at Wright Research, I'm not sure actually if people are aware, we sort of try to look at everything in terms of factors, right? What is the quality of the stock as a metric? What is the value of the stock? And what is the momentum of a stock? We rate stock based on these factors or themes, which will sort of help us evaluate the potential of outperformance of that particular stock. So that is what we did. We tried to understand, okay, which is the factor that we should be betting on right now, right? So as investors, you might be, there are people who do quality investing, there are people who do momentum investing, there are people who do value investing. So we tried to see, which is the factor on which we need to bet right now. So here on this chart, you will see since 2023, obviously momentum has been the strongest factor. Momentum works really well in India because of the bull market. Whenever that happens, momentum has the biggest upsurge, right? But in the recent times, if you look at it, quality as a factor seems to have done better than momentum, right? So obviously, and this change seems to have happened somewhere in February or early March, right? And this is something that we all noticed. There was a literal trend change. We saw correction across the board, with the highest correction in the overvalued segment, in the low float small cap. And since then, we have seen the trend sort of change or shift a little bit towards high quality names, right? So that is the trend that we are observing, and I think that is the bet to take, at least for the next few months, as the market gets more stable, right? Talking about quality, quality has been a strong factor. Like we said, it has been doing the best recently. If you actually evaluated different sectors in terms of quality, you would see right now chemicals, metals, pharma, autos, and textiles seem to be the highest quality in terms of segments. And this is based on our proprietary rating. Somebody might have a different interpretation of this. In terms of lowest quality rating, you would see the IT pack, the FMCG, consumer durables being rated low in terms of the quality of their earnings. So if you were to pick stocks based on the quality, I think the metals and the chemicals and the healthcare would be the stocks to pick. Talking about momentum, right? Momentum, we definitely do have a bias towards momentum. In our small cases, we have very popular momentum products. And these products tend to do very strongly whenever there's a bull market. In a bull market, momentum does extremely strong. And because we have a positive bias towards the market, we expect momentum to do well also. While momentum definitely has seen some ups and downs in the recent couple of months, but it is again, it has come back very strongly. So here again, in terms of highest momentum, we are looking at construction, engineering, automobiles, metals again being rated highly in terms of momentum. In terms of lowest momentum, you will see technology, chemicals, and consumer durables are the ones that are rated. Now, quickly, let's go over to another factor, which is value. Where are we seeing value? So, metal pack seems to have the highest amount of value, along with textiles, consumer durables, automobiles, and the lowest value is somewhere in the construction, technology, and chemical segment. So, all in all, I think definitely metals look strong, construction looks strong. We're seeing automobile also come up with the top of all the list, and that is what the bias is. Even in our portfolios, we do have a few. We do have banking and financial exposure also, so we think that is also interesting, and that is also coming up strongly. That was a brief overview of the market. I wanted to be a little data driven here, Kamal, because a lot of clients come and tell me that you are a quant, so I expect some data from you. So that's why I included this in the presentation. Here, there's a quick overview of our portfolios. Our portfolios have had a very interesting, I think we launched at a very correct time. It's been a very interesting 8 months. So our flagship Wright Factor Fund, which is the most subscribed PMS of ours, this one has given 58% in the last 8 months, right? And what's really interesting here is we were doing very strong in the first 6 months. We were ranking as the best performers across the board, and then February, March, market became very volatile. But I'm extremely happy about the performance of my strategy here, February and March, because the exposure that we had in September, November, December, January was the one that, if we stuck with that without any risk management, we could have seen much more significant correction. So the risk management in the strategy, in fact, delivered really well in February and March, and we ended up being flat with not much damage for sure. And April, again, the strategy has recovered very strongly. It is up some 7-8%. In terms of our AUM also, we've seen a lot of adoption right now. I think when we talked, we were way smaller, and right now we have touched more than 135 crores. And like I said, we are very happy about the good risk management done. I think being young or being small, definitely we can do strong performance in a bull market, but people judge us for the risk management, right? That is where people understand your worth. So we are very, very focused on making sure that we are managing the risk also well. With that, I'll just quickly introduce 3 of our strategies. We have the Wright Factor Fund, which is a multi-factor strategy. So the things I talked about, which is value, quality, momentum, growth, this is trying to combine all of these factors. There is no one answer to the market. And the value investor is not always going to do well, and a momentum investor is also not always going to do well. But maybe a mix of them would have a much more consistent and profitable return. That is the philosophy which Wright Factor Fund follows, and it has actually delivered on that philosophy in the last 8 months at least, having given 57.5. All of this is post-cost returns, which is 32% over and above the benchmark. Then we have our second strategy, which is called Wright Momentum Fund. This is purely momentum, right? So it is not looking at the fundamental factors, but it is sort of looking at some forward-looking expectation metrics. So along with price trends, it is looking at forward-looking expectations and combining them to create this allocation. This has been outperforming the benchmark, but it has lagged my factor fund by a little bit. I have a high-risk version of the momentum fund also, which we call Alpha. Here, again, we are picking based on momentum, trend, and expectations, but we are only selecting 10 stocks. So with 10 stocks, what happens is, if you have these high-performing 10 stocks, then your rate of growth of the portfolio can be very fast. But again, when you see a correction, you could see sharper correction in the strategy also. So that is what we saw with Alpha. Alpha was the leader till January, but February, March, we saw some correction, and very fortunately for the factor, we saw almost a flattish return, right? And all of the strategies seem to be recovering very strongly from the January numbers, right? Now with that, let's quickly just go over the allocation that we have. So like I said, we do have, banking and financials are the bigger allocation, but along with that, we do have the construction, the automobiles, and a lot of stocks from interesting sectors like electrical equipments, and a bunch of different sectors here. It usually is very diversified, and the focus is not just, I'm talking here in terms of broader segments, but within these segments, we are picking up very strong headwinds. So right now, you see that even in the construction segment, there are smaller industries which are picking up trend, and we are sort of recognizing and allocating to them, and therefore we have a very interesting set of allocation. But also, what's very interesting here is that that our exposure is not a lot into very small stocks, so it is still large and mid caps. And this categorization is, it's a simple categorization. If the stock has crossed 20,000 crores, we call it large cap. Some might not call those stocks large cap, some might still categorize them as mid caps. But that is the categorization that we do. Essentially, it's a mix of large and mid caps by any category, and we are definitely expanding the universe. We are looking at small caps. We've allocated to a few in some of our strategies, so we do have that outlook. But right now, the allocation is obviously quite strong, and it is holding very strongly in terms of any volatility. In terms of our momentum strategy, again, you will see banks being the bigger chunk here, along with some auto ancillaries, airlines, electrical equipments. We have some IT, telecommunication, construction also here. This also has a mix of large and mid caps. In terms of our alpha, you will see some small cap exposure. You'll see, steel and iron, or definitely, it's picking up on the metals trend. You have construction, you have automobiles, finance, etc. in this strategy. So I think we have a very good, healthy mix of stocks within our different portfolios. I think we are picking up a lot of interesting tailwinds from the market, being data driven, and I will expect that the strategies continue to keep that outperformance, and we sort of handle risk also well in this current market. So that is more or less from me, Kamal, and we can go to the Q&A.
Perfect, Sonam. You can maybe then stop the screen share.
Right.
So how has been April month? Because April month has done decently well. So what has been your performance across strategies?
So our best performing again for us was the factor strategy, right? It ended up doing, I think, close to 8%, right? And our alpha also was quite strong. Our momentum is around 5.5%. Alpha was doing extremely strong, but then we had BSE in our portfolio, and the last day of the month ended up being a correction in the BSE stock. So, that has also corrected, set up around 5.5%.
That you are adding some of the, stocks which are in their tailwinds. Can you please give some ideas, some description on some of those names that you are trying to mention?
No, why not? So to talk about that, see, we picked up in the automobile industry, we picked up stocks like Cummins, right? You would see today, even if you look at it, while the rest of the market has been very volatile, this stock has been very strong, and the same has been the trend for the last quarter while we've held it. We picked up stocks like Vedanta, SAIL in some of the strategies, right, which are stand out in the metal segment. If you talk about, we've had some petroleum stocks that have been strong. Even we've picked up stocks from the pipes and the fasteners and those segments like electrode building components. So to name a few, something like a graphite, electrocast. Some of these stocks, we're seeing some emerging trends happen, and we are slowly picking up those stocks.
So, human fund managers generally have a bias and they have a long-term horizon. And being a quant fund manager, there is a lot of churn that we see in the portfolio, and investors who like quant, they don't mind paying extra tax for extra churn. At the same time, they expect portfolio to maintain lower beta or to have a kind of a construct whereby, when markets are showing signs of weakness, quant fund manager maybe, increases the cash position in a much more unbiased manner than maybe a human fund manager.
Right.
That's so in your fund as well?
Yes, we do that. But Kamal, I think being quant, what you have to notice ki numbers move every day, right? So if you are reacting on those numbers very actively, then you can actually end up having too many trades, right? So I think that is something that we understand, that there is a limit, right? You can end up doing too many trades, but then the cost will eat up the whole thing. So we try to find a balance. So we work with a system where we try to find a balance with the number of trades and which are necessary. We will only trade when it actually makes sense. We do it systematically. So typically, Kamal, you will see 1 or 2 trades happen into the whole portfolio for every month, right? So let's say I have a 20 stock portfolio. I'm trading once or twice. You could see between 40 to 45 trades in a year. So our turnover is not like excessive. It could be between 150 to 200%, right? So we make sure that we are doing that. But yes, I think why do we have all of this turnover? Because it is critical, right? The trends change. If we hadn't rebalanced in February and March, then we would have seen a bigger impact in our portfolios when the correction happened. Similarly, if we did not shift our allocation after that and adapt it to the market, we would miss out on the tailwinds, right? So again, we think that in the Indian market, it does make sense to have some churn, but having excessive churn is an extremely bad idea. Doesn't work for anybody, and we try to avoid that.
So if you have to put a ballpark, for last 1 year, what has been the churn?
So last 1 year, see, on an average, we would have, like I said, would have traded once or twice in 1 or 2 trades in a particular month, right? So it would have been close to 150%, right? That's what I would assume on an annualized basis.
So, but when you're changing 1 or 2 stocks per month, then how come it becomes 150%? Because your portfolio would have
20 stocks.
20 stocks. Sure, does make sense, right? Perfect. And how are your 2 portfolios, which is factor and alpha, different from each other?
So factor is supposed to be a mix of factors, right? So obviously, momentum and trend is there, but when there is risk, that portfolio pivots a little bit towards quality, towards value, right? So it combines the fundamental and technical, and that is what that one does. Obviously, it does have a lot of momentum in it, but it combines other things also. Our alpha, it is a pure play momentum bet, right? We are just betting on the momentum in the market. And we are taking a high risk with that momentum. So it can end up doing extremely strongly in a bull market, right? When the market is look at last year, Kamal. If you picked up these stocks, for example, the IRFC, the BSC, CDSL, MCX of the world that we did pick up, you would see a very sharp returns if you're just holding few stocks. But then again, whenever the market corrects, people start dumping those stocks, and you see some correction in this strategy. But in the long term, definitely, it would be a very strong strategy, right? So that is what our alpha does. And typically, our clients, some of them do want to take a lot of risk, they'll go with alpha. Many of them want to take only moderate risk, they'll go with factor. Some of them want like a mixture. They would say, give me 80% factor and 20% alpha. Give me some sense of the higher risk so that I can become comfortable, and additional capital maybe I'll add to alpha. That's how they do it. So we're very happy to work with each of the clients on what they want.
So till now, over the last 1 year, which out of 3 has received maximum number of clients?
So I have highest number in factor only, and then I have alpha, and then momentum.
So because we know next 3 months are very critical on macro factors. Though you mentioned that interest rate cuts may not happen sooner, because though growth has started to show signs of slowing down, but inflation has not shown signs of going down, and maybe interest rate cuts may happen little late. There are other macro events which are like elections in India and elections in the US, and valuations are also high. Markets kind of at these levels. Would you not see all these factors and increase your cash levels? Are you prepared if any eventuality happens which is like unexpected or which is like not liked by markets? I know if I ask these questions from a human fund manager, they will say, Kamal, our role is to ensure that diversification in the portfolio is there. We do not take cash calls. We are always long only. You're also long only, I understand that, but at the same time, because it is quant, there has to be something which in my opinion investors would want, and hence what is your answer, especially during such times?
So I think, Kamal, right now, like I said, our allocation has shifted a lot towards large and mid caps, right? And it also, again, our allocation is also extremely diversified, right? And see, the cash call will be part of this strategy. Cash call will come. See, we have 5% gold in our factor portfolio, and we held some cash in March, right? We were deallocated in March. We have reallocated now, and the portfolio is doing well. But I think the allocation that we have, which is biased toward large and mid cap, and the set of sectors industry, I believe that will be robust with any volatility. Again, if there is an excessive volatility that happens in the market, there is a risk event, then we will, the strategy has that built into it, that it will step out and increase the cash or gold component, will handle that risk. But right now, the scenario is not throwing any very loud warning signs, right? There is a concern, right? The Fed might as well handle it well, right? We all fear that the Fed will not cut rates for a long time and throw the economy into recession, but they might as well do their job well and cut the rates at the appropriate time and avoid any such high volatility. So there is no clear loud warning sign to deallocate. I'm definitely planning to around the elections, Kamal, I'm definitely planning to hedge. We with one of our first clients, we actually experimented hedging his portfolio, which actually worked really well for him today. So we are sort of prepared to do that around the election time, and we'll go a little risk off at least for the week of the results. And that is one thing that we're thinking about. But otherwise, I think we expect the allocation to be strong, and there's a lot of opportunities, right?
So quant-based funds are generally positioned in portfolios with one most important factor, that they are unbiased. And like in last 2 years, we have seen massive rally taking place in PSUs. And PSUs is something which had a bias, with many quality focused fund managers who used to say we don't do PSUs, and they kind of did not do PSUs and they have underperformed. But I'm assuming that because quant was unbiased,
yes,
in 1 year you would have participated.
No, definitely. So and it's not just because of trend, right? Obviously PSU stocks picked up a lot of trend, and any trend following strategy would pick up PSUs. But Kamal, we actually picked up PSUs early because of value, right? PSU banks and the PSU stocks that we picked up, they actually showed a lot of value when we picked them up, and we did have PSUs. What we did, Kamal, in February was that we realized that PSU exposure actually went up high, right? It was around 30% in some of our strategies. And then they all started moving in one direction. So as quant, see, we are trying to identify patterns, right? That is what our job is. We try to identify patterns and try to make sure that you are handling or taking advantage of that or handling the risk of those patterns, right? So we saw that pattern, okay, all PSU banks are suddenly moving together in one direction. Do we need to limit our PSU exposure? We modified our strategy. We limited PSU exposure. So right now also we do have PSU, right? We have PSU banks, we have all the RECs and PFCs and all those stocks in our portfolio, but we have limited. We have cut down some exposure to PSUs in February and March.
And how did you realize and how did you understand that now is the time to cut? Because exactly in February and March, we did see correction. And
So I think so. This realization happened right after the budget, right? So if you remember, right before the budget, you saw this strong rally in railways, defense, and all, which we participated in. We got a lot of returns out of it. But right after the budget, suddenly, the biggest stocks in our portfolio, let's say we had an IRFC which started seeing a correction, right? And we saw that, okay, suddenly PSUs are all moving in the negative direction. What does happen in my strategy if I limit that exposure? Will my return go down a lot? Will my risk go down a lot? What we saw was return doesn't go down a lot. My risk is limited because of that. So we applied that and ended up cutting a few stocks in that sense.
And then, you replaced those stocks with some of the large caps.
Yeah, but not the traditional large caps. I don't think a lot of stocks from the Nifty 50, but we did add very interesting stocks which probably are not talked about, but are sort of doing really well right now. So to name a few, I talked about Cummins, which did really well today. There's a stock called Schneider, which has done strongly. It is in the sustainability and manufacturing segment. We had Medanta, which again went strong, then was volatile for a bit. So a lot of interesting names. What we saw was suddenly after PSUs, these MNCs companies were coming into our portfolio. But I think the allocation is looking strong in the sense right now.
And how what are those, I would say, factors in your quant which made you kind of, find out these stocks and add, your portfolio?
So right now, Kamal, we are looking at, like I say, quality, value, momentum. Momentum is simply trend, right? Simple trend in the stock. So I'm not just looking at previous returns, but I'm looking at some technical definitions of trend. For us, Kamal, another very important factor I look at is ratings that the stock received from analysts. That is a strong factor that I sort of include. Along with it, in terms of quality, I would look at, let's say, the equity turnover of that particular company, or let's say their asset turnover and a bunch of other ratios. Combination of those will determine the quality. When I'm looking at valuation, I'm not just looking at simple PE ratios. I'm looking at certain other ratios, comparing it across the industries and using that as a metric. So we have tested these ratios and identified the ones that we think work best in the Indian market in the last few years, and depending on that we select these stocks. So a combination of these metrics is what has led us to select some of these stocks.
So if you had to invest your own money for long term for wealth creation, will you allocate it to quant fund or you will give it to human fund manager?
I allocate it to our fund, which I've done, right? So no, I think see, especially in a country like India, why is everybody excited about India is because of the wide range of opportunities that are there, but the opportunity does not seem to stick in one sector, right? There are emerging sectors that come up and the directions change across different interesting places in our economy, and therefore I think being quantitative will give you that added advantage. So we've done that experiment. We've tried out doing. So obviously, I cannot compare myself to my strategy to a genius fund manager who does a picks manually every time and looks at a bunch of things. But if I compare, our momentum strategy to a quality strategy to a value strategy, we see differentiated returns. And I think the current tactical strategy that we are taking seems to be an ideal way to invest into an emerging market like India. And I think we have shown that in the last few years, right?
Sure. So, let's talk about fundamentals, because I keep, hearing that the markets have been rallying because of, liquidity. But if we talk about, say, sales growth numbers, earning growth numbers, for say Nifty 50 companies, they are gradually slowing down these numbers, right? Though the GDP for last year was good, but ultimately stock market in long term, definitely cannot ignore fundamentals.
Right.
Liquidity is high, markets are in momentum, but let's leave markets aside. Let's understand what Quant has to say about fundamentals. I want to understand, how do you evaluate these fundamentals when you kind of, use Quant in taking decisions?
Right. So obviously, I think the growth is slightly slowing down, right? But that is the nature of the macroeconomic scenario, right? When the rates are very high, then obviously uh, the value in the company goes down low. I think once the rates are cut, you would see valuations also rise up. So price would be a secondary, but you will see value also increase within the companies. And I think that the nature of the macroeconomic scenario right now is leading to slightly lower growth. But I think as the scenario changes, we would see the emergence of different sectors, and we're seeing moves happening based on expectations also, from metals to IT to real estate. There's been a lot of moves which can only be explained in terms of expectations by the market. Uh, and I think we are, while we are definitely looking at the fundamentals, we are also betting based on the expectations that the market has. uh, and we still have a positive bias. We think the markets definitely will be strong. There will be risk scenario that you will have to counter, which we are already countering with our very highly diversified and large and mid cap focus. And if anything drastic happens, we'll step in and handle the risk accordingly.
The three factors that you have mentioned, quality, value, and momentum. These are the ones that help you and kind of, I would say, are the area of focus for you to identify a company before adding it to the portfolio. So can you state three examples of companies which are like, in the portfolio through the lens of these three factors?
No, why not? So in terms of, let's say I'm talking about momentum, right? So in our momentum portfolio, I can name, let's say, Trent as a stock, right? It has been a high momentum stock that has been picked up a few months ago. We have Vedanta, which is another stock that has picked up. Again, we can see that it has had a very strong trend. Similarly, Prestige, a real estate stock I have, is a high momentum stock that we have picked up, and you will see all of these three stocks coming from three very emerging sort of segments. Now, talking about, let's say, value, right? So I think initially stocks like Maharashtra Bank are something that we picked based on the valuation numbers. A stock like, I would say, Bajaj Holding is there because of the valuation. We have we have something like REC that was initially picked up as a combination of value and momentum, I would believe. Right now, in terms of quality, again, I have named a few stocks like Cummins, right, which is a strong quality name. We have something like a Dixon, which is a strong quality name. I also hold Maruti, which are again strong quality names. So I think that gives you a sense of how we are defining these metrics.
Sure. For the audience, I would just like to give one disclaimer. We may have discussed a few stocks, only for understanding the thought process and how the thought process is executed, and for examples to understand it better. But absolutely, this is not to be construed as any kind of advice for anybody, because obviously Sonam as a fund manager can exit any of these stocks at any point of time, depending upon how Quant is throwing signs. But if any investor is kind of delving into these stocks, it has to be at one's own risk. It is only for understanding purposes. Moving on, Sonam, I want you to kind of touch base on this point that you have three PMSs now, and anybody who wants to actually invest for wealth creation over next 3 years at the current levels, which is the one PMS that one should kind of invest. I want to invest money for next, say, 5 years plus. My goal is wealth creation. I want alpha, and I am not a short-term investor. I'm a long-term investor. So, which is the one of these three PMS that you will recommend, and why?
See, I think I typically recommend the factor fund because it is a very strong performing fund which has a diversified exposure. It is not just looking at the price trend, but it is looking at multiple factors, the fundamentals also. It is highly risk managed. It has 20 stocks, very diversified in a sense, and we expect it to do strongly. right? In the coming years, as we bet on these diverse set of factors. So that is the one I would typically, will be the default recommendation. Now I do have another strategy that is high risk, which is the alpha strategy. It is not suitable for everybody, but let's say somebody has a long term horizon and they want to take some high risk with the money they're putting in. So we give them some alpha allocation also. We create a mix of these two strategies.
So how would high risk in alpha actually culminate to high return? How can I I would say have a high conviction that yes, if I'm taking higher risk over longer term, I will get high alpha higher than factor portfolio?
See, so in terms, I've done a back test on these strategies and analysis on these strategies. I do expect alpha to maybe give an incremental 10% CAGR over the factor in the longer term. And see, the simple definition of that would be that, see, if you are picking 20 stocks and one stock in that rallies 10%, then you only make a small amount, because 0.5% out of it. But let's say if you are holding 10% in that stock, you would make 1%, right, on the overall portfolio level. So if you have picked up these high performers and you've taken risk in each of them, then your potential for return goes higher, right? But also, when they will correct by 10%, then you will see that hit in your portfolio also. So if you are able to actually pick up 10 strong stocks for the market, then you will see sharper returns with this high risk strategy. See, the nature of the Indian market is that at least in 70% of the times, Indian market has been in the bullish zone, and the expectation is that continues in the future. And if we are going to see a few more bullish markets in India, then again these high performer stocks would shine, and we could make a lot of alpha through them. And that is the intention of that strategy. We have modified this, we have evolved that strategy over the last few months also. We create a mix of factors with which we expect the risk to be a little bit lower than what it has been before. And I think it's a good strategy to allocate to, and I do expect it to do very strongly, right?
So basically, the alpha strategy has a more concentrated portfolio. It's like 10 stocks versus the other factor portfolio having 20 stocks.
Yes, and with those 10 stocks also, it is just betting on the momentum instead of anything else.
Understood. And how do you decide on weights on both the portfolios, alpha and momentum?
So it depends on the risk profile of the investors. Yesterday I had a call with somebody who said, I just want alpha, don't tell me anything else. So which is, I just help them understand what is the risk and return there, and that's perfect for them. Somebody might say, okay, I want to be moderate. I do definitely want a lot of returns, but I don't want a scenario where there could be a lot of volatility. So we give them factors.
Sorry to cut. In the respective portfolios, on one side you have 20 stocks, which are bought with the lens of quality, value, and momentum. On the other side, you have 10 stock portfolio, which is purely on the lens of momentum. Hence, obviously that's aimed to generate 10% higher return in the factor portfolio. But in both these portfolios, how will you define weights? Are these equal weighted, like 5% each in the first?
No. So again, see, with Quant, Kamal, I don't just define equal weights. I use some quantitative methods through which you can optimize weights. I'm trying to maximize my returns while reducing the risk. That is how we construct the portfolios, and the weights on the different stocks will differ. So it's not equal weight at all. The weights could differ across the different stocks. For a client, if I were to define what is the allocation to factor and alpha, that will be totally on their risk profile. Somebody might say, okay, just give me 10% exposure to alpha. Somebody might say, give me 50% and all that, right?
Understood. So for everyone who is watching us, I would just like to again convey that like today we are doing this webinar. Maybe some of you are attending it for the first time. We do these webinars every Friday, and the intent of doing these webinars is to understand the fund manager, also understand the markets, also understand the conviction of the fund manager, because we could be doing a repeat webinar, and it is important to understand how fund managers believe and think in the various phases of markets. Right. And we really are very sincere in our approach, and it is a cordial invitation to all our viewers who are keen to really make very good investment decisions for themselves, to maybe book calls with us, you can log on to pmsaifworld.com and you can book your appointments with us. We are absolutely happy to make you, take very good decision and then give you answers to more questions that, may not have been answered in this forum. Sonam is one fund manager who is like currently young and is growing at a faster pace and is managing both risk and returns well. We have understood her, strategy over the last 12 months, though 12 months is a shorter period, but we have also seen the small case that she has been running for more than 3 years, that performance also. But absolutely, it's a investors ultimately, self decision. We will present all the data and will also kind of give our perspective. But at the same time, as a wealth manager, we also understand, what is the investor's profile, background, and based on that, we help him select not only the best product based on objective evaluation, but also a suitable product to his risk profile. And that is where, obviously one has to select these products, and that is the reason, I was asking these questions.
Right.
Thank you, everyone for joining us today in this webinar. It was really interesting and insightful interacting with you, Sonam. Thank you. Thank you once again. All the best.
Thank you for having me.
Yes, sir.